Okay, so good morning, everyone, and welcome to today's macro snapshot. We are Friday, February the 21st, 2025, recording this about 7 o'clock in the morning. So, okay, let's have a quick look at a couple of charts. Yesterday, we had something which sort of upset the market. We had a bit of a soft day in the equities. You can see here the ES here, the S&P 500 futures, of course, having just a little bit of a soft day, not a huge amount, like a 30, 40 basis point drop. But what's interesting is that they're just finding it very, very difficult to pierce this kind of triple top. Technically, we're only 24 hours away from, all-time highs. So there's no need to panic or to sort of overread into this. And this is still, a very constructive kind of chart. But the reality is that, for a couple of months, we've been stuck in this sort of trading zone. The market is just finding it very, very hard to push through with energy and more to the upside. And possibly, it's just the fear of the tariffs, which is not a resolved situation. In a more specific and sort of shorter term sense, we do have the option expiry rolling off today, February the 21st. So maybe there's been a bit of pinning, a lot of people saying a lot of the dealers are buying dips, selling rallies. So it's kind of hasn't moved much the last 4 or 5 days. And who knows, maybe once, the hedges get unpinned this morning and then this afternoon for the roll-offs, maybe there'll be more volatility to the upside. But basically yesterday, we also had a Walmart reporting before the bell, and they had pretty strong fourth quarter earnings, as we all know by now. But it's really the guidance essentially saying that maybe the boost they had of selling some of these drugs like Ozempic is kind of fading a little bit, and really they were saying that the consumer possibly is slowing down a little bit, is a little bit more cost conscious. And so the reason that the market sort of punished this is that this chart has been almost in a sort of a linear fashion, completely straight up for the last sort of year or so, or whatever, for Walmart. So coming down about 5-6% here, although already seen the pre-market, sort of relatively sort of stable. But I think the real story here is just this worry that possibly, is the US consumer starting to feel some cracks. And it's interesting if you look at things. I just sort of came across an interesting sort of chart this morning. If you look at, for example, consumer loans, you see the transition into delinquency. So people who are sort of late, this is 30 days or more late. And actually, I saw one yesterday for 90 days or more. And you can see here for credit cards, which is in the blue, kind of sort of going up the delinquency rate. You also see for sort of car loans, auto loans going up, and even for mortgages, a little bit of an uptrend in sort of late payments and delinquencies. So don't want to read too much into it because, household savings are still pretty robust. But the reality is that they too are fading. The household savings are fading after COVID. And who knows with some of the US government layoffs and the firings, which is not going to make a huge difference. But the reality is, we are starting to get 5,000 here, 10,000 there, 5,000 there. There are, a few more people losing their job in the US government. And just going to be interesting to look at some of these delinquency rates. And we had also a soft retail sales. So you put it all together, soft retail sales a week ago, Walmart is showing a little bit of caution, delinquency rates going up. There are some small signs that maybe the consumer in the US is starting to feel the pressure of, these very sort of high prices. So we'll keep an eye on that. And so the market just finding it hard to rally. But as I say, today we do have we had the option expiry, so maybe that will, as I say, unpin some of the dealer sort of hedges, and the market will be able to push high. Also interesting just to keep an eye on not only on the ES, but let's have a look at see how the Mag 7 is going. And the other issue here is that as we know, the leadership of the American stock market for sort of a year or two has been in these sort of large cap, mega cap tech stocks. And what we can see here in the Mags ETF, which is a agglomeration of all those, is that they're really stuck in sort of a pennant here and really very, very low volatility and just waiting for some direction. And you have to say, until and unless the Mag 7 can resume leadership and push higher, it's possible that we're just going to be stuck in this sort of trading range for the ES, or indeed, if these things start to sort of fall down, that's going to, potentially really, that's going to be like that triple top in the ES chart we just looked at, and things could come down. And of course, what we do get on, I think it's Wednesday, we get Nvidia. There's going to be a lot of attention there on, supply chain issues, data center build out. Is there any threat finally from DeepSeek coming out of China? If Nvidia misses, I think, the Mag 7s will be dragged down, and I think the rest of the stock market, and it might get a little bit ugly, but we'll see that on next Wednesday. Also interesting to look at the equal caps. Equal caps doing okay, but again, they're not at new highs, but the breadth of the market is widening a little bit. So that's a positive. So it's almost as though, some of the market flows, the money flows are going into the equal caps. Right at the expense of the mega caps. But as you can see, if we look at the Russell, which is the small caps, small and medium caps, that's still pretty weak, and it's not at all near time highs. So the point is that the U.S. stock market is a little kind of range bound at the moment. I don't want to say super weak, and it looks as though the flows are going to things like Europe. So you see here we've got the FES, the Euro stocks here, the top 50 and the stock 600 actually doing pretty well. It had a bit of a fall just on the idea of less rate cuts. Isabel Schnabel's comments 2 or 3 days ago, but kind of grinding its way back up again and doing quite well. You see the DAX not quite as strong. So maybe this is an opportunity also just to talk a little bit what's going on in Germany. And you can see just what I want to talk about here. It's a bit of a complex situation. I don't want to go into too much detail, but we do have the German elections this Sunday. I'm going to keep it simple and say that you have the incumbent party, the present party, the Social Democrats, not doing particularly well, only about 15, 18% at the polls. The more business-friendly Christian Democrats doing quite well with about 30%. But of course, the wild card is the very, very conservative, even very right-wing, extreme right-wing AfD polling about 20%. But what's going to get interesting on Sunday night at the Open is, and just from a market perspective here, and we'll keep an eye here on the DAX and on the Euro, is the market wants stability, and ideally the market wants something which is pro-business stability. So the perfect situation would be for the DAX and let's say the Euro would be if the Christian Democrats came with a clear majority, but that looks like that's absolutely impossible to happen. And then you say, well, okay, can they do a coalition? And that's when the problem becomes, it makes itself felt, because in a sort of a normal world, so to speak, the Christian Democrats would maybe then ally with, let's say, the AfD on the right wing and just do a sort of a pro-business conservative government. But the idea is that because of their neo-Nazi links, the AfD is absolutely persona non grata at the table, and they're not going to be welcomed into any coalition. So essentially, those 20 or 23 or 4% of votes will be left on the side. And that's going to force potentially a very awkward and messy coalition between, let's say, the Christian Democrats and the outgoing party, which is the Social Democrats, who paradoxically may be, able to sort of actually come back into the government, even though they've been rejected by the voting population. And then, of course, you start thinking about potential alliances as well. Some of the more left-wing parties, I think it's called Die Linke, which is the extreme left, and the Green Party with 2 or 3% of the vote. So the point is, what the market really wants to see on Sunday night at the Open after the elections is a clear, simple pro-business coalition. But the risk is that actually there's no clear winner, or at least no party which is able to form sort of a healthy and stable coalition. And we could get in a situation which we saw in France a few months ago, whereby there's sort of very unstable governments. It's very messy. There's a lot of compromise. They're not natural partners, and could lead to a lot of instability, especially, of course, as we have the situation with Russia and what's going on with geopolitics. So if we look at some of the markets, any hint of instability, I think, is going to be a net negative here for the DAX, the German index, probably in the bigger scheme of things for the Euro stocks as well. If we look at some other markets and we start looking at, let's say, the Euro, where are we? So the Euro, which has been doing okay, but it's really finding some resistance here at 105. I think the Euro does not like instability, so I think the Euro would weaken again, a percentage point or two. I think definitely any sign that there's not going to be a clear sort of stable coalition. Euro, Swiss franc, I do believe that definitely has some more downside. And of course, keep in mind that if there is a clear victory for the Christian Democrats and they're able to do a very stable coalition relatively quickly, all of this will be the opposite. So that'll be Euro positive, Euro CHF positive for the Euro stocks, etc., etc., etc. The other thing which is sort of interesting is also to look at some of the debt situation, because if you look, I've got a little graphic up here just showing Where are we? I think it's here. So if you look, sorry, I thought I had that. Um, Yeah, so if you look at the deficit here as a percentage of GDP, you can see here that Germany, which is in the blue here, is actually it has a fairly strong sort of fiscal situation, and even compare that to the US in the white here and in the gray in France. So the point I'm trying to make here is that if we look at the German election, there's also going to be implications for the German Bund. And we can see here that recently, for example, we look at the long end of the German curve, it's gone down up a bit today, but it has been going down quite a lot. And this idea that, the Christian Democrats, who's a fiscally conservative party, they are actually open to negotiating the removal of the so-called debt brake, which will allow more fiscal spending, more debt issuance for social programs, maybe more debt issuance and fiscal spending to actually, throw a bit of money at the discontent in the populist part of the population, and also to pay for defense spending. So it's going to be very interesting, all these negotiations. What is going to be interesting as well is, again, I talked about it yesterday, is just what's going to happen with these spreads. If there is any kind of messiness with the German election on Sunday, you've got to believe that that could actually benefit, to be honest, like the Italian spread. So that might actually go down a little bit more. But just keep in mind what happened in France after the very messy elections called, in the summer, just after the Olympics, where we saw that there was a complete paralysis in the government. There was no ability to form a stable coalition. And you can see here that the spread between the French bonds really sort of pushed out above Germany here. So just going to be interesting to see if there's any sort of negativity about that. And that's probably going to be really reflected in the euro. And if you look at the euro, just getting back to the euro, it's been doing pretty well against the US dollar. And you can say, why has the US dollar been down? The US dollars I mean, we can maybe have a quick look at the Dixie here, the dollar index. You see it's fallen quite a lot down to this sort of 106.5 levels, which I thought would be pretty much the support. It is bouncing a little bit this morning. But yesterday we had Besant from the Treasury. Why is the US dollar weak? Basically saying that he didn't think it would be necessary for quite a long time to issue more longer term bonds. Also talking about the Fed, if we saw the minutes, the Fed, maybe their quantitative tightening program being a little less aggressive, so a little bit more liquidity, less long-term bond issuance from the Treasury. So that basically bull flattened the curve. So you have a bull flattener, that's going to be bad for the US dollar. And then, of course, there was the announcement yesterday, or the comment by Trump that there could be some sort of grand new trade deal in the works between China and the US, which is good for sort of global risk sentiment and a net sort of negative for the US dollar. Just by the way, we also have Besant, the Treasury Secretary, talking to the Chinese today. That's going to be his first conversation, apparently. So there could be some positive, sound bites coming out of that. It's like, oh, I had a great conversation today with the Chinese. So there could be a little bit more of a risk on sentiment today. So there's a bit of a risk for the US dollar. But structurally, you've got to say that the US economy still seems to be performing pretty well. There is potential political paralysis coming up in Germany. We know that France politically is very, very unstable at the moment. And of course, we still have a lot of uncertainty with the Russia-Ukraine situation. So I'm just looking at the euro here, which has had a nice run. Again, where are we? The euro has had a nice run, has had a nice retracement here. I think it's going to be difficult to push, too much higher. I mean, could it get up to maybe this level here, 106? It's possible. But I think honestly, anytime we get, towards the 105 level, even higher, that's going to be definitely here going to start thinking about, establishing some kind of short position, maybe start building a position there. And we see the fragility in Europe. I mean, not massive, but we had, for example, the PMIs this morning, which France was very, very weak, for example. So if we look at French PMIs, you can see here the flash PMI February 44.5 for the services versus the expected 40, almost 49. Okay, so that's almost like 4.5 points lower than expected, and much lower than the previous, which was 48. You look at the manufacturing, that was pretty weak, still in contraction territory, 45, and the composite. Now, I've got to say the German numbers were better. They are in expansionary territory at 52.2. Still a little less than expectations. And you look at the manufacturing, though, still 46. manufacturing PMI is still in contraction. And then if you look at the EU as a whole, are still in contraction at 47. Services doing okay at 50, still a little bit lower than expectations, and the composite at 50. So if you look at the overall situation in Europe, look at the German manufacturing. It's horrible. If you look at European manufacturing, very weak. Services is okay, probably tourism and whatnot. But the point is that Germany is under some kind of pressure. France is definitely in a not a great situation economically. And now you add on top of that the need potentially for more deficit spending in terms of defense spending. And you've got to say that the European economies, they do need some support from the ECB cutting rates and to keep the interest rates low if they're going to be doing a lot more defense spending. But it's got to be a battle though, because with all of this deficit spending and potentially weakening economies, you've got to think that maybe the yields could be going up as well. So interesting situation. And that's why I do believe that overall the euro, as I say, it's had a nice little sort of bounce back, but I think it's maybe sort of enough at this point. And also technically, if we do a fib retracement here, you're starting to get into fib retracement zones here. So interesting days ahead. Let's see what happens. The other interesting move in currency was the Japanese yen, which has been very, very strong. As you guys know, it's very, very strong. Again, bouncing off the 50-day fib retracement. You see this big fib retracement here on the purple. It's a 50-day fib retracement at about 149.3, which also is horizontal support. So no surprise there technically to be bouncing off. But there's a couple of reasons for that. So let's first of all look at some of the strength, and we can just look here and just look at some, I've got some data. So we had some data last night from Japan. You look at the CPI, look at this pretty strong 4% CPI. The prior was 3.6, so higher than, well, not higher than expected. It was expected at 4, but very strong number. If you look at excluding fresh food, 3.2, that was up. If you look at excluding fresh food and energy, the core number up at 2.5. So basically inflation definitely pretty strong here. If you look at just different measures in Japan of inflation gauges, you can see here all three of them. If you look at CPI, core CPI, and the core CPI, so to speak, there's the BOJ's target of 2% in the purple, and everything's sort of heading upwards. So not only is it stabilized above 2%, which was a problem for a long time. You see, if you go back into the 2010s and everything, they had deflation. You see, it's been, as you can see, it was below 2% for a long, long time. Then it got up, then it came back, but now it looks like it's heading up again. So that's basically giving the BOJ the sort of the green light to keep on potentially hiking rates. And if we actually look and just look at a couple of things, we can see what's sort of expected here. So if we look in Japan, we can see that by the last meeting, 1.4 hikes sort of basically being priced in by the market. There's some talk that they might do 2 hikes this year. And of course, that's being represented a little bit. That's been shown a little bit. If I look at like the Japanese, look at the Japanese yields on the 10-year, you see that yield, November, December, just ramping up now as we speak at 1.43. So basically, as those Japanese yields get higher and higher, that becomes more and more attractive to some of the, like, let's say, for example, the Japanese pension funds to get out of maybe US treasuries where they have to hedge and they lose money, and just to repatriate, to sell those, take the money in US dollars, convert them back into Japanese yen, which is pushing up the yen, and buying some Japanese bonds, because domestically they get unhedged 1.43%, which is the most they've been getting, as you can see, for a long time, going back to the good old days of having sort of negative rates. You can see that's grinding up. But overnight, though, as I say, we did get just a slight bounce in the Japanese yen, and probably if we just put that on, I'll put it like on a 3-minute chart just to have a little bit more granularity here. You can see here that the US dollar did sort of push up a little bit around about 6 p.m., 7 p.m. And that's just probably also because we did get the strong CPI. So that's a positive for the yen. So you say, well, why did the US dollar, have a little bit of strength? And I think it was a technical bounce, as I say here, these horizontal levels and fib retracements, but also Ueda, the Bank of Japan governor, he was pretty quick to get on the news wires and essentially say that he doesn't really welcome what did he call it, a sort of an unstable and too fast rise in the Japanese yen, but more specifically the yields. And we saw that the Japanese yields, or the yields on the Japanese 10-year, are going up fairly aggressively and quickly. And he doesn't like that because it's too unstable. So he came in and smoothed the market and calmed down the market by essentially saying that the Bank of Japan was prepared at any point to enter the market through intervention, essentially to buy bonds, almost unlimited number of bonds, which then put some downward pressure on the yields, upward pressure on the price, which calmed down the yen. So that took a little bit of market, sort of verbal intervention by Ueda of the Bank of Japan. Let's see if that's long lasting. Personally, I think the US dollar, it's getting to a point where it's sold off quite a lot. I still think that with the uncertainty about tariffs and trade and the strength, the relative strength of the US economy, that the US dollar's sell-off cannot go too much further. Could be wrong on that one there. We also, as I said, we had some weakness in the Eurozone PMIs. Just in terms of what's coming up today, just want to have a quick look. Oil kind of stuck in the mud a little bit. It's sort of weakening overnight. Where's oil? Oil down. Yeah. So oil down, almost $1 or so. No, so down 60, so about 91% here. So oil just, it's finding it very hard. All rallies here are being sort of checked. You see, it only can rally for, actually the 3-minute chart. But if we look on the daily, you'll see here again, the most consecutive up days, like 2 or 3, then it's been whacked 1 day, 1 up day. So if you look at all this period here, the maximum sort of rally is only 2 or 3 days. The oil just cannot maintain a bid. Not to say it's going to collapse. We've been through that a little bit on the videos, but I think oil is just range trading here, and there's not a lot of energy. A final thing, just want to say here, guys. Actually, I'll just show you quickly that we have some data today. So let's just go back into this. Yeah, so just looking again, just quickly on oil. That's where we're trading now, the white curve here. So just the April contract. You see here the outright price from yesterday, which is the blue one, has come down. So it's still above a week ago, but you can see the front of the curve. The price is down. The curve is very flat. So just not a lot of energy at all in oil. Just in terms of what we've got today, not a huge amount of stuff. We've got the University of Michigan. That's the final reading. That's also very political at the moment. It seems, Democrats are sort of positive. It's a very political reading. So let's ignore that. But what we do have is the S&P Global US Manufacturing PMI, Service PMIs, and Composite. That's going to be a preliminary number for February. That's interesting. They're expected to remain, kind of solidly in expansion territory. So, essentially what that's saying is that, the purchasing managers have a relatively, strong sort of sense of a confident sense of where the US economy is. So let's keep an eye on that and see if that changes everything. As I say, could be a bit of volatility today because we have option expiry. We have the SPX in the morning and then things like the SPY running off this afternoon. Let's see what happens. And of course, there's also always the possibility of some tweets by who, the man in the Oval Office, or is it Mar-a-Lago these days? Okay, guys, I'm going to leave it there. Have a good day. Have a great weekend, and we'll be talking, no doubt, next week. Thank you.